Let's talk about Walgreens, which is going private, being bought out by this private equity firm, Sycamore Partners. This is kind of a big moment for this very iconic American company. This company's been around for 120 years. It's been a public stock for almost 100 years. It's been public since 1927. And now you have this icon of American consumerism, and it's being bought out by a PE firm for a tenth of what it used to be. 10 years ago, this company was worth $100 billion. The price tag today is $10 billion. Your reactions to this news, Scott?
I think they're just overstored. I think they're doing the right thing. Again, capitalism in the market's at work. I can't believe this thing was ever worth $100 billion. What I'd be curious, and I don't know if you have any information on this, is that my go-to is, well, this is Amazon, another victim of Amazon, but I don't really know. Do you have any thoughts on what's actually going on here?
I think it's a whole confluence of things, and the way I would summarize it is just bad management. I think probably one of their worst mistakes is just their inability to modernize their pharmacy business, which they really depend on. I mean, those Walgreens pharmacies were incredibly traditional when you compare it to the pharmacies at somewhere like CVS. And I think they woke up one day and telehealth had taken off and reimbursement rates had come way down. And they just got crushed, especially against CVS, which was establishing itself in the pharmacy benefit manager business too. They also bought Village MD, which was a disaster. They were just too late to the party. They bought that company after COVID. It didn't work. They ended up taking a $6 billion impairment charge. And then I think the final thing were these lawsuits. They just got a ton of lawsuits, and most of them they settled on. And just this year, a couple months ago, they got sued by the DOJ for essentially selling opioids illegally. So I think it's kind of simple. From a management perspective, it's been a disaster. I think the question is, what does Sycamore do with this company? Where do they go from here? It's expected they're going to split it up into 3 units, where you have Walgreens Pharmacy. They also own Boots in the UK, which I'm sure you're very familiar with now, which is their UK pharmacy, and their healthcare unit, which is called Shields Health. And Sycamore did a similar thing to Staples, which they bought back in 2017. One interesting stat from the team that I'd like to get your reaction to: 1 in 5 private equity-owned companies go bankrupt within 10 years of acquisition. And that is 10 times higher than the rate of publicly owned companies. So I guess the question I would pose to you is, what does Sycamore do with this company? And could they just bankrupt the company possibly based on that stat?
I mean, clearly they're going to cut costs. They're probably going to change management and severely reduce costs. And the hard part about retail is that you have to enter into these very risky business contracts called a lease. And everybody wants the same real estate. And the owners of this real estate are smart at maximizing their revenue by signing you up for a 10-year lease. So when you pick, I mean, you have to be very thoughtful. So, and the history of retail is Restoration Hardware goes public, and they think we got to grow. So they sign a bunch of bad leases. They're really promiscuous. And then similar to Walgreens, 3 and 4 Walgreens are not profitable. And it's a 10-year weeping sore. Unless you declare bankruptcy, you can't get out of that lease. So you're just losing money. So real estate ends. What are they going to do? They're going to let a ton of these leases expire and hopefully short up. As it relates to private equity and bankruptcy, that's not surprising because private equity is usually, let's take all of its cash flows and use it to lever up such that we can have more upside and finance the acquisition with cheap debt. And when it doesn't work, they declare bankruptcy. Now, having said that, the debtors or the bondholders charge a certain interest rate to calculate it in the risk of default. And when it defaults, the bondholders get to seize the assets. And when a private equity company or a private equity-backed company has to, when it goes bankrupt, generally speaking, the private equity, all the equity capital they put in, they also get wiped out. So it does lever up and, go risk on a company, but it also creates a certain sense of urgency. I think private equity has been good, a net good for society. I'm not one of these people that says, oh, they're ruining everything. I don't think that's true. There's a lot of entrepreneurs who've made a lot of money selling to private equity. And the thing I like about private equity is they're usually very good at getting management vested in terms of the upside of success. They're actually quite generous, whereas venture capitalists, I find, are primarily just with rare exception, just mendacious fuck douchebags who pretend to give a shit about anybody and then wash the founders out. Speaking for a friend, but so I enjoy working with private equity. I think debt tightens the focus, if you will, and most of the time these things, it does make sense. And also, there's two parties to the trade. The company doesn't have to sell the private equity. They've entered into this agreement knowingly. The people who are financing this debt enter into this trade knowingly and are getting hopefully a good interest rate to reflect the risk. But this is a company that's a shadow of itself. It sounds to me, what I would want to know is what percentage of their leases are coming up for renewal that we can get out of. Because that's the obligation here that is most scary. And that's why a lot of retailers, good retailers, declare bankruptcy, because then they can go and cherry pick and hold on to the leases they want and get out of the contractual agreements with the leases that are hurting them. So I wouldn't be surprised. I wouldn't be surprised if Sycamore actually does pretty well here. Do you want to hear my CVS and opiate story, Ed?
Please.
My CFO came in at L2, came in to me and said, I need to speak to him. So she's like, there's some really crazy charges at drugstores all over Manhattan. And I looked at him, this is not me. This doesn't make any sense. I'm like, it must be fraud. And she's like, no, it's not fraud. It's your assistant. And it ends up that my assistant was addicted to opiates and was going to every doctor in Manhattan getting a script for opiates and then going into a CVS or a Walgreens and not only getting her opiates, but buying $1,000 or $2,000 in cosmetics or gifts. And she was not only a criminal, she was a stupid criminal. And she would sign for everything and have it delivered to her house. So we're like,
yeah, we think it's you.
Get this. She managed to spend, I think, over 5 months or 7 months, $120,000 on my corporate card at various CVS and Walgreens all over Manhattan. And I remember calling her.
This is probably why Walgreens failed. They lost her.
They lost her. And I remember calling her. I'm like, look, we have an issue here. You are clearly addicted to something. There's $120,000 on charges on my card. And not only that, she's like, oh, I don't know what you're talking about. I'm like, you signed for this shit at your address. Your signature's on this stuff. You decided to have someone drop it off at your apartment, which wasn't like, you're not exactly what I'd call a very, this is disorganized crime. And she immediately went into rehab, claimed disability, and tried to sue us for the options that we owed her. She dropped the case when I said I was going to turn it over to the Manhattan DA if she didn't drop the case. But anyways, that was my last assistant, Ed. That was my last assistant.
I'm glad we learned that. Yeah, we learn a lot about hiring decisions on this show.